It is a pleasure to introduce you to the Burton Book Review podcast, with interviews of America's leading authors by our nation's finest law professors and scholars. Each podcast is featured on the American Bar Association Journal and on theburtonbookreview.com. And now, to our program.
Hello, everybody. We're delighted to have today with us Professor Ray Madoff, who is a professor of tax law and estates law at BC, Boston College Law School, and she's the director of the Forum on Philanthropy and the Public Good, so she's also an expert on philanthropy. She has written an excellent new book called The Second Estate: How the Tax Code Made an American Aristocracy. It's a wonderful short book, 180 pages, written in a very accessible manner, even though it is treating a subject that is complicated and difficult for people to wrap their minds around, namely our tax code, our federal tax code, and federal tax policy. Thank you so much for joining us today.
Thank you for having me, Alan. It's a pleasure to be here.
I wanted to start just by asking you, in general, why you wrote the book and why you wrote it now.
Yeah. So I wrote the book because I've been working in this area of tax policy for quite a while. And the book was really a product of frustration over the way I felt that taxes were being presented to the American public. There were a number of things. I felt that people were being told, first of all, that the tax system is too complicated for people to understand. And it isn't. I mean, while it is in all of its little points, the truth is the broad principles are pretty easy to understand. But even more concerning was that when you understand them, you see all of this other kind of false information that's been spread to people. And I would say one of the that this was particularly true when it comes to issues around the wealthy and the extent to which they're subject to the tax system. As we'll talk about, I'm sure at some point, many people think of the estate tax as this very burdensome tax that imposes lots of taxes on the richest Americans. But what they don't know is how the estate tax has become so riddled with loopholes that it hardly produces anything at all. The other, what I'd say is a myth in this area, is that the rich are already paying lots of taxes because, and you hear this statistic a lot, the top 1% of Americans pay 40% of the income taxes. And this is a statistic that is true, but used in highly misleading ways. And that's because people hear top 1%, and they think they're talking about the richest Americans, Zuckerberg, Bezos, all of these people. But in fact, what we're talking about is high earners, high paid lawyers, doctors, business people, bankers, who are making lots of taxable income and are paying lots of taxes. The problem with our tax system is that for people who are living off of their investments and inheritances, they are able to essentially avoid taxes altogether. For them, taxes are optional.
Yeah, you point out that the income tax, the graduated progressive income tax rates that we have 7 different rates going up from 10% to a top rate of 37%, that those are applicable to wages and salaries, earned income, and some kinds of unearned income like interest on a bank account. But they are not applicable to capital gain, long-term capital gains and dividend income, which are subject to zero tax rates for some point in time, and then a lower 15 or 20% tax rates, plus there's a 3.8% surcharge if you're a high income earner and you have those kinds of income. Why is there that difference? You would think that in a system, a capitalist system where we want Horatio Alger income, we want people who are working really hard, the waitresses, the security guards, or the lawyers or the doctors who are making salary income, you would think that they would not be taxed at a higher rate than capital gains and dividends.
It's interesting because Andrew Mellon, who was a big anti-tax person, very, very rich person, you know, the Mellon family, early banking family, and he was Secretary of the Treasury in the early part of the 20th century under 4 different presidents. He was a known anti-tax conservative, you know, somebody opposed, but even he argued that it makes no sense to tax wages higher than investment income. Because wage income, when somebody relies on their wages, that type of income both requires a lot of work and it's also susceptible to the vicissitudes of life. Somebody who earns money, they could become sick and not be able to earn money. On the other hand, when we look at capital gains, when we look at profits from investments, we see that those are produced regardless of effort and they are much more consistent. So he also thought that it should be taxed at a lower rate. When you look at the arguments, there's like 40 different arguments, but none of which actually add up to any particularly strong argument. 40 incomplete arguments. Some say it's because the investments are being held for a long time, so it's primarily inflation, right? But of course, you get the reduced rates after holding it for only 6 months. So not all investments are held for a long time.
So is that particular argument is made to justify a lower capital gains rate?
Yes, exactly.
I see. But you're right. You don't have to hold it for. I mean, there may not be much inflation in that 1 year that you hold it to get the lower rate.
That's right.
So that doesn't make sense. Another point you made in your book is that the idea that we're encouraging savings doesn't hold up because an interest on a bank account is ordinary income. So, you know, and that's how most Americans do their savings, I would think.
The other argument that you hear these days is that somehow that money is doing more for society than other money, right? Because this is investment capital and it is growing the economy. But this also doesn't really withstand scrutiny. I mean, if I have Apple stock and it goes up in value and I sell it to somebody else on the secondary market, none of this is starting businesses or doing anything like that. So it's a lot of really limited arguments about this.
Right, that argument would be applicable if you were investing in speculative ventures, non-public companies, new startups. I mean, we're really riskier things. If you're just buying somebody's Apple stock, you know, who just wants to sell it, it doesn't really hold up. I agree with that. And what's interesting is the other argument I had heard in the past was it's double taxation. This goes to the dividend income, that, you know, we tax corporations on their profits and then they distribute the profits in terms of income. That's double taxation. I want to hear what you say about double taxation, because that argument, number one, seems to be overused, and number two, because there's lots of transactions where there's a taxation at each level, and so that there's number one. But number two, if you talk about double taxation, the FICA taxes would appear to be the real double taxation.
That's right.
You know, FICA taxes on wages and earned income, which is totally duplicative of the income tax.
Absolutely. And I think that I think honestly the issue about entity level tax and individual level tax when it applies to corporations has some merit, right? Because we have some pass-through entities where there's only one level of tax, and then for corporations we have 2 levels of tax, but for S corporations we have 1 level of tax. You know, there's not a lot of broad reasoning there. But the problem is the capital gains rules apply so much more broadly than just to stock, right? It applies to every asset that somebody might have where there's no double taxation. Land, there's no double taxation. Cryptocurrency, other types of assets that somebody has, artwork, right? So the capital gains rules are far broader than simply stock. If they want to give corporations credit for when they make distributions of stock, that's fine with me. But that shouldn't be flipping all of our capital gains versus ordinary income rules.
And if capital gain, long-term capital gains and dividends were subjected to the same rates as ordinary income, for example, and I gather that was the law between, let's say, 1986 and 1988 for a couple of years, right?
Yeah, proposed by Ronald Reagan.
Yeah,
enacted under Reagan.
Right. So, and again, one of the interesting things about your book is you put all of these things in historical context, including the fact that we've only, the history of the income tax and the estate tax, the reliance on tariffs before that in our history, and what different presidents have proposed, different reforms. And it's very interesting to see that some of these changes that you favor have been advocated by both Republican and Democratic presidents. That is a very interesting point, I think. So can you say a little bit more about the basic reforms that you favor?
So I think that what we have to, I want to just step back a little bit and put some stakes in the ground about where I see the issues. So the problem I see in our country is that we currently raise about $5 trillion in taxes from all sources. Income taxes, payroll taxes are the biggest ones, corporate taxes, and then the little tiny sliver are estate and gift taxes. And so we raise $5 trillion, but we spend like $7 trillion, just under $7 trillion. So one big problem with our current tax system is that it is not imposing enough taxes to be able to meet our expenses. And the national debt is so expensive that it is costing us a full $1 trillion a year just to pay interest on the debt. That's not even counting paying down the debt. Just paying interest on the debt is a full $1 trillion a year. And note, we only collect $5 trillion in taxes. So this is a very serious cost in our country. So one failure of our system is a failure to generate enough revenue. The other failure in our system is for our system was designed to impose its greatest burdens based on those with the greatest capacity to pay. So it was originally, the income tax was only applied to the richest Americans, and then even as it became applicable to everybody, or almost everybody, it was still imposed at progressive rates because of a belief that people who have more should pay more. And on top of that, backing up the income tax system was the estate tax, which imposed an additional tax on all transfers by the wealthiest 1% of Americans. Okay, that's sort of how our system was designed, how it operated for many years, and how many people continue to think that it operates, because we still see those rules on the books. The problem is that there has been a shift over the past 40 years. And now, instead of imposing the greatest burdens on those with the greatest capacity to pay, we have created a system in which those with the greatest capacity to pay are able to essentially avoid taxes altogether by basically following what I call the tax avoidance playbook. And those things are, one, they avoid salaries, so they don't take high salaries because those are subject to high taxes. Two, they don't sell their assets. So when Mark Zuckerberg's stock goes from being essentially nothing to being 200 billion, 300 billion, whatever it is today, right? No tax on that. And there will be no tax unless he sells the stock. And so that's the second problem. And then the third problem is that inheritances, any money received by gifts or inheritances or life insurance, is entirely excluded from income taxes. You don't even have to report it to anybody. So if somebody gives me $10 million, that's just seen as my personal business. And yet, if I find $10 on the street, I'm supposed to report it to the federal government. So by not taxing investments and inheritances, we are not taxing the largest types of accumulations of wealth of the richest Americans. So we have actually taken the richest Americans out of the system rather than imposing greater burdens on them. So if we see that as the problem, then the answer is to bring investments and inheritances back into the income tax system. I propose that we do this by something that was proposed by both Presidents Nixon and President Obama, and was adopted in Canada. And that is that we change our realization rules, the rules of when capital gains are taxed, to not just being upon sale, but also being whenever property is transferred. So if you transfer it by gift or you transfer it at death, then you tally your gains. The gains should always be taxed to the person who earns it.
Right. Many people may not realize this, but if you die with appreciated property, there's a step up in basis. So that capital gains is under current law completely avoided. The person who dies never pays it. The heirs inherit it at the stepped up basis. And as you say, Canada follows a contrary rule, and President Nixon and President Obama both proposed that the US do that. And as I gather, that's been in effect in Canada for quite some time, and it's easily administrable. It works pretty well.
Yes, that's right. And then the other aspect of the problem is about our failure to tax gifts and inheritances and life insurance. Now, one might think that's because we have a robust estate tax in place. But the problem is that there was a campaign against the estate tax causing many Americans and many politicians to shy away from the estate tax as a kind of legitimate form of taxation. And rather than repealing the estate tax, what Congress did is they simply stopped enforcing it. People found loopholes, and Congress didn't bother closing it. And the last time a loophole was closed was 1990. And so what we have is an estate tax system that essentially does nothing, and then an income tax system that gives a free pass to all these forms of income, no matter how great they are, right? You can inherit $100 billion and you still don't have to report it on your income tax. The only thing where things happen is in the estate tax, which has completely been destroyed. And so we have a really broken system when it comes to inheritances. If we want to provide a preference for some amount of inherited wealth, we could do so and we should do so. But I don't think any American would think that we should have an unlimited exemption for money received by gifts, inheritance, and life insurance, whereas everybody else has to pay taxes on their unemployment compensation, their retirement money, their wages, their barter exchanges, their found money, their lottery winnings, and, prize money, any of these things. They were all subject to ordinary income taxation. And yet we're going to say that when somebody receives a $100 million life insurance policy, there's just no tax on that. It doesn't make any sense.
It does seem odd that we have this incredibly broad definition of income for purposes of the income tax at the federal level, including, as you say, found money on the street, gambling winnings, I guess, barter, the value of labor that's bartered, and yet we do not include inheritances. Do you think most Americans understand that? I mean,
no.
Yeah.
I'm sure they don't. And I'll tell you one reason is, and this is for sort of many Americans who have, who have some money, they've heard that if you give more than $19,000 a year to your kids, there's a problem. And they think that the problem is an income tax problem. So many people have asked me, like, isn't it the case I can't give more than $19,000 to my kids without them having a tax problem? But this is something that comes up in the estate and gift tax context, right. And it has nothing to do with income taxes. So
people think that they actually owe a tax if they give more than 19, or the recipient does, even though they're just using up their lifetime exemption and they have to file a form with the IRS to record that. Yeah, it's interesting. The Tax Foundation has done some surveys, and they have discovered that most Americans do not understand the difference between a deduction and a tax credit.
Well, that's not surprising. I don't think, it's, I think there's a lot of things that Americans don't understand because, frankly, nobody's tried to explain it to them. Right. And I think that's the problem,
Another interesting thing that the Tax Foundation found, I was reading, was that most Americans don't understand the graduated income tax. They don't understand that if you hit a higher bracket, only the amount of earnings above that level is taxed at the higher level. Some more than a majority actually believe that if you go above it, all of your income is taxed at that higher level.
Yeah, I know.
So that's a pretty fundamental misunderstanding of the system.
I agree.
And your book does an excellent job. I think part of it is that the big numbers are confusing and hard to wrap your mind around. part of it is just the incredible complexity of our tax code. Your book is about the federal tax code, but there's also state and local taxes. And there are state estate taxes and state inheritance taxes too, and there's state income taxes. So it all becomes extremely complicated for people. And
But I think that the story that our tax system is complicated is a story that serves the status quo. And I think that we should all be mindful of telling the public that certain things are too complicated, but certain things are not complicated. Our failure to tax inheritances is not complicated.
Right.
Our failure to tax these enormous growth and gains is not complicated, and the way that rich people avoid taxes by avoiding salaries is not complicated. So I think that there's a lot that the public can learn and understand in a very easy to understand way. And I'd say one other thing that I think the American public can understand, if they're told this, is the amount of wealth that is owned by the wealthiest Americans, and how false it is. You'll often hear this saying that, like, no point in taxing the rich, they simply don't have enough money, our government is too big, our deficits are too big. It's something I read all the time. But when you look at these numbers, remember we talked about how the total revenue that we take in is 5 trillion and we spend close to 7 trillion, and therefore we add our deficit turns into we add almost 2 trillion more to our national debt. These are the numbers from 2025. You want to guess how much money is owned by the richest 1%? You probably know because you read the book.
50 trillion or something like that. Yeah.
55, now it's close to $60 trillion. We had a $2 trillion deficit. The richest 1% of Americans have about $60 trillion today. And we essentially impose no taxes. They can be avoiding taxable income. And the estate tax in 2025, which is supposedly a flat 40% tax on all transfers during life and at death, only raised $28 billion. 28 billion.
Half of 1% of the total.
Yes,
yeah.
Exactly. So it doesn't raise anything.
But it's interesting because your book, you are against, in general, wealth taxes because of practical and legal issues that arise. And you actually are in favor of doing away with the estate tax. Now, maybe you don't disagree with it in principle, but you think it's become basically a fig leaf. So why are we giving the mega rich cover by having this? Instead, we should tax inheritances. And if we tax inheritances on a progressive rate, that's also more nuanced. And even with an exemption for $1 million or whatever, you could say you inherit the first $1 million without the tax, and then you could spread out the remaining taxes over 3 years or whatever. You could do all sorts of adjustments.
Exactly.
And people would be taxed based on where they are in that graduated scale, which would be more progressive.
That's right. And that's because I think that the estate tax had an Achilles heel to it, or has an Achilles heel to it. And that is because it is imposed on donors, it does seem to be potentially, for some people, a double tax on the same person, right? Because if somebody was not like a Mark Zuckerberg, who doesn't have much taxable income, but instead was just a high-paid lawyer, banker, doctor, whoever, right? It's possible that they paid a lot of high taxes during their life, and then they die, and we're taxing that taxpayer again. And then you have to explain to people, but you have to know that their heirs aren't paying taxes. But they're like, but to this person, it seems like an unfair double tax for somebody who had been taxed. Of course, some of those people haven't been taxed at all, but it makes the story very complicated to explain and harder to understand. And that's why I think what makes more sense is to tax gains to the person who earned them and inheritances to the person who received them. That's something that all Americans can more easily understand and can figure out, well, what's the appropriate exemption amounts and things like that.
Yeah, the counterexample would be somebody like a member of the Mars family who is incredibly wealthy, and not to pick on them in particular, but the Walton family, somebody who's inherited a gigantic amount of money tax-free because it's not income, and then they pay the estate tax, but they haven't worked for any of it. So, that's the counterexample to the person
But
who's,
yeah, but because of my area of law, estate planning, they don't pay taxes because these are put into multi-generational trusts that are avoiding taxation in their estates. So
And
they're
that's
neither paying estate taxes nor income taxes.
so that's the problem of Congress
Yeah.
stopping closing the loopholes over the last
Exactly,
35 years
exactly.
or so. Okay. A couple of I wanted to highlight, it seems like there's the carried interest exception, which has been debated, and it seems to have drawn bipartisan support, but has always derailed at the last minute.
Right.
It seems like your changes that you would suggest, including especially equalizing the rate of tax for earned income and dividends and capital gains, that would just do away with that problem, wouldn't it?
Yes, that's right. Because a lot of the gaming in the system comes from people getting capital gains treatment, which is at a much lower rate than ordinary income treatment. And it makes our tax code much more complicated. And that's why if we want to simplify our tax code, we should be repealing that distinction and treating it all the same. And then also there's another special treatment for certain types of partnership interest, 199A, businesses, right? They also get a reduced rate. We should have a system where a dollar is a dollar is a dollar, and it's all subject to tax. If you get lots and lots of dollars, the most of it can be taxed at higher rates. We could have a progressive rate structure, but we shouldn't have different rules for different types of income. It doesn't really make sense.
And would you apply the Medicare tax and the Social Security taxes to all different kinds of income as well, or just?
That's a little bit beyond my pay grade type question, I'd say.
Okay.
I think we have to do more to make our Social Security system, solvent. People have been putting in enormous amounts of money over the years, and they are entitled to get Social Security. Right now, current workers are paying for retirement benefits of current retirees, and it's not fair to them to say, yeah, sorry, you've paid into the system, but now we're no longer going to be paying you. We have to make our system solvent as a matter of fairness to the current and future working Americans. But there's a lot of ways of doing it. There have been lots of different proposals. We could raise the cap on salaries above $176,000, which is where it is now. There's a lot of things that can be done.
But you would not replace the whole FICA tax with something and pay out of general revenues for Medicare and Social Security. You think that's too much of a heavy lift?
I don't know. I would say, again, this is not my area of study, but my concern is, what is my area of study was how we got the system in the first place. The payroll taxes, the problem with them is that they are regressive, meaning you start to pay taxes. A kid who works as a counselor at a summer camp pays FICA taxes, even if they don't have enough money, even if they don't earn enough to pay $1 in income taxes. So the taxes are imposed at a very low level. They're essentially imposed at a flat rate. They're basically regressive. But as FDR said, who was involved in enacting our current Social Security system, the power of this system is that it is seen as a form of insurance. Everyone is contributing, and then they're going to be getting money back on the backside. And I think that has made it, he said, I don't care if it's regressive, it makes it politically stronger. And I think the Social Security has proven to be politically strong. And I would be mindful about creating a system that is not politically strong. I think if we just throw it into general revenues, then it makes it more vulnerable. Or we do means testing or things like that. I'm not a big fan of those ideas.
Okay. Yeah, I was just wondering because it seems like there would be a huge political backlash to cutting back Social Security benefits. And so I wondered if this structure, which creates a duplicative, tax on earned income, as you point out, and is really just a way of putting a special tax on people working now to pay the benefits of people who are retired. Ideally, it would be, funded from general revenues, and then you could free up earned income for just one set of taxes.
But I think one's entitlement to receive the benefits is in part tied to how much contributions are made.
Okay. Yeah, I mean, the Supreme Court, I think, has said there's no real entitlement to anything, that Congress can change it.
Yeah.
But politically, it's a different matter. I agree with you.
Right.
And there may still be some value to having it be a contribution that way. And it also just may be too difficult to change, although there are systems like the VAT taxes that a lot of OECD countries seem to have and really like.
Yeah.
And those can be made progressive, as I understand it, by certain measures, and they work well, but they do raise prices. So that's
And they are regressive because they're only tied to consumption.
Consumption.
And very rich people can only consume so much of their wealth. If you have $200 billion, you know, when you consume $1 billion, that's a lot of consumption.
Right.
So it leaves massive amounts of wealth not subject to tax.
The buy, borrow, die strategy, which is, how does that actually work? Because if someone is borrowing against appreciated securities so that they don't have to sell them and pay capital gains, they nonetheless have to pay interest on those loans. And so as a longer term way of funding a lifestyle, it seems like at a minimum one would have to be willing to pay that interest on an ongoing basis.
Absolutely. But the thing you have to realize is compare the interest, particularly these are extremely well secured loans and they are held by very rich people. So lenders, people in the professional business of lending, are offered the most favorable rates for these types of loans, right? Because they're fully secured, you know you're getting your money back. And so, and you have to compare it by not selling the stock, they get to have continued growth. And a lot of our stock has been growing at a pretty fast clip, far greater than the interest rate. And so it's worth it to them to hold on to the stock, have it grow in value, even if they have to maintain a certain amount of debt.
But does part of that strategy depend on the existence of the estate tax, in the sense that one is presumably way over the exemption amount? And so one thinks, I'm borrowing all this money, and when I die, that debt will be discharged and my estate will be brought down. And so it's partly driven by the
I
estate.
think there are far better ways of reducing an estate, and they are done through creative gifting. That's really where all of the tax avoidance happens. If you hold on property until death, it's very hard to avoid the tax. But the way people avoid the tax is they do lifetime giving in ways that are structured to hide the value of what they're transferring. Things like rolling grats you might have heard of. Those are all designed to shift value to beneficiaries in a way making it seem like you gave them nothing.
If you did away with the estate tax as you propose and replace it with an inheritance tax,
Not an inheritance tax, and just brought gifts and inheritances and
Right.
life insurance into the income tax system. I think it's a
Right.
mistake to call it an inheritance tax.
okay,
You can
fair enough,
Yeah.
fair enough. But if you did that, if you made those two changes, what would happen to the rules relating to gift taxes?
Well, you wouldn't have a gift tax, so you wouldn't have those rules. But I think that what you would want to do is in the income tax system, it provides an opportunity when we when we say that gifts, for example, or life insurance or money received at death is subject to tax, we can now have exemptions that make sense to us. For example, we probably want to have unlimited spousal transfers, right? So somebody can transfer as much as they want to their spouse. We might want to have an amount that we can transfer free of tax each year, like we have in the gift tax system, right? So right now it's about $19,000. We could even raise it to $25,000 or $50,000, right, to keep people out of the system. But what you would want to do is you would want to adopt, you would not want to bring over these rules that corroded the estate tax. So for example, we have currently an annual exclusion, right? You can give $19,000 per year. It is meant to cover holiday presents, birthday presents, and winter holiday presents. However, what people do instead is they take these amounts and they put them into crummy trusts and they give crummy letters and they put multiple beneficiaries in there and they multiply the benefits, right? It's a big way of avoiding taxes, and they do this every year. And We shouldn't allow that. If this exemption is meant to take out birthday gifts and holiday gifts, then we should not allow it for transfers in trust unless maybe the person is a minor or unless maybe it's a single beneficiary trust. But we've allowed it to be used in a way that entirely undermines the whole system. So the idea is that when we bring some of these exceptions into the income tax world, we have an opportunity to make sure that they are conforming to the purpose of the exception and not conforming to the distortions that have occurred as a result of 36 years of non-regulation by Congress and the IRS.
Why do you think Congress has stopped regulating these loopholes? Do you have an idea?
Yeah,
about
because
that?
I think that the estate tax was so successfully vilified that even Democrats were afraid to restore it.
Yeah, your book does a very interesting job of describing that whole campaign, Frank Luntz, and relabeling it the death tax, and how various presidents, even some Democratic ones who you thought maybe would have gone the other direction, have continued to raise the exemption
Yeah.
and make it basically meaningless now. Okay, let me ask you finally about charitable giving,
Okay.
if I could, which is in your wheelhouse. We have now something called donor advised funds, which allows people to make charitable gifts and get the deduction in the year they make that gift, and yet not pay out those funds to charities under any timetable. Why do we have that rule, and why does it make sense, and why doesn't Congress fix that? It seems very strange.
So what's interesting is that if it actually operated the way these things are sold, the way you describe them, if they operate in practice exactly as you describe them, right? So someone donates property to their donor advised fund account and they get massive upfront deductions, the best deductions you can get, better than the deductions you can get given to a private foundation, right? You're treated the same as if you gave the money to the local food bank for tax purposes. And that's because you signed something that says, I have given up complete dominion and control over this money. I have no power over it. Fidelity Charitable can take it. They can pay themselves salaries. They can use it to fix up the offices. These are the documents that all the donors sign. But of course, none of the donors believe that those are the rules that are going to apply to them. They'd never sign that type of thing. And the sponsors of the donor advised funds, they're not going to act that way either, because they're interested in simply essentially filing some form of quasi bogus understanding of the relationship, right? Legally, they've got full legal control of the money, and that's what gives you the tax deduction. But there's a whole side understanding. And the side understanding is they're not going to spend the money. They're going to hold it in an account and wait for your non-binding advice. So you're
Which
just
they will
making a
follow.
recommendation, right? But
Which they will follow and
course they
distribute the
are.
money according to your wishes, or you wouldn't be doing it in the first place.
of course they do. And if they don't, you can take your money and take it to another donor advised fund sponsor.
Right.
So it's all of this stuff is happening outside of the law. The way that it operates is under one set of rules that are kind of a wink and a nod set of rules, but the legal agreements that people sign basically say, I have given outright control of this property to this charity that's going to use it for its charitable purpose. It's absurd. And the reason Congress hasn't tackled it is anybody's guess, but I think it's because the people that operate donor advised funds, all of the big banks, financial institutions, and the community foundations are getting lots of profits from
Right.
management fees. And so there's lots of lobbyists that are saying, you know what, let's keep this system. It's good for us.
Let me ask you one other question about the tax benefits, especially to the really wealthy, of making these contributions, because somewhere in your book, I think you say that you could get up to a 74% amount back, or in tax expenditures, basically a benefit from the federal government subsidizing your tax. And it seemed to me it might even be higher than that, especially if you consider state taxes. But for example, if you donate appreciated property and you have a very low basis, you're going to save 23.8% of capital gains.
Yeah.
Most states tax that as ordinary income, so you might save another 10,
Yeah.
or in California,
Right.
13%. Then you get the tax deduction for the full value of that. You're going to get that on your federal taxes. If you're in a high bracket, it's 37%, and then again in California, you get 13%.
Yeah.
So it seems like, and then if you think about the estate taxes, if that would have been subject to the estate tax, that's a 40%.
That's right.
And there are state estate taxes. It actually seems to me conceivable that some big contributions by the mega rich could be money makers for people. Is that?
I don't know if they can go so far as be money makers, but you're right. They could be significantly more than that. 74% only counted capital gains, ordinary income, and federal estate taxes.
Okay.
It did not include the 3.8% addition on capital gains.
Okay.
It didn't include any of the state tax benefits. So you're right. It could definitely be higher than 74%. Making money might be more than it does, so I don't want to say that it does that, but it could definitely be significantly more benefits.
But it's so interesting because that puts things in a very different light, particularly if you think about tax expenditures as you characterize them correctly in the book, as you're getting a subsidy from the government, whether it's the federal government or the state government, to make these contributions, and yet you are able to, as the donor, especially if you put it into a private foundation like the Gates Foundation, you're able to decide how it's spent.
Yeah, or whether it's spent. Because
or whether it's spent.
Although it has, private foundations technically have a 5% payout rule, you can meet that payout rule by giving to a donor advised fund. So it's another meaningless rule. I think that we should sweep out some of the meaningless rules from the tax code.
Why is it only a 5% rule for foundations? By the way, why isn't it something higher? I mean, you're getting
because the theory of it is that they convince Congress that sometimes people want their charitable purposes to exist in perpetuity, right? Let's say that you thought Irish step dancing should always be here, and it might go out, then you need to be able to exist in perpetuity, and as long as you can earn 5%, you can exist in perpetuity.
Well, I guess that makes some sense. Anyway, let me ask you one final question.
Oh my God! Too much. It's already 4:50.
I just want to ask you about your writing process, because the book is very well written, very clear, and that is not easy to do with a subject matter like this. So did you have an especially good editor, or did you read it to your kids or your husband, or how did you get it to be so readable?
Thank you so much. I do appreciate that question. And I appreciate the compliment. Thank you. One thing is that I had a period before I wrote this book where I wrote a lot of op-eds. And so I have sort of been, and I teach. And so I'm always interested in explaining things to people who don't know anything. And so, and that's kind of really my MO in everything. I'm speaking to the general public. Sometimes I sit in a coffee shop and I think like, okay, did this thing that I say, would I be able to explain it to the person at the next table? So I'm very mindful of like, what is it that people know and what is it that people don't know? And I really try to break everything down, because I find that I love when people speak to me in a way that they assume I know nothing. And because it's when they start assuming I know things, I don't know whether we know the same things. It gets a lot more confusing. And so because I like to read things that lay it all out, I do the same in my work.
Well, congratulations again on an excellent book. Once again, The Second Estate. Everyone should read this. It is a fantastic book, and it helps to inform all of the current debates about wealth taxes, which we didn't have a chance to talk about, but are discussed in the book, and all the other things we should be doing to make a better tax system. Thank you.
Thank you so much. Thank